Hey everyone, James here from Northeast. I'm here today to talk to you about how does tax work? Well, firstly, in Australia, our tax system is what we call a tiered system. What that means is that if you have a very low income for the year, then you're going to pay proportionately much less tax than if you had a much higher income. And you can see the effect of this in the tax rates for 2022-23, noting that they don't change for the next financial year too. For the first $18,000, if you earn less than $18,000, then you're not going to pay any tax at all. Thereafter, then every dollar after 18,201, you'll pay 19 cents in the dollar. Now, I note that for all these rates, these 19%, 32.5, 37, in a lot of cases, in most cases indeed, it's going to be 2% above this because you add Medicare levy on top of this. But for simplicity, we've got the rates here without Medicare levy. What this means is that if you are earning $50,000 for the year, for example, that's your total taxable income, then you're likely to pay about $7,500 in tax. So that represents about 15% of your total income gets taken away as tax. Now, conversely, if you earn $500,000, then you're going to pay over $200,000 in tax. I think it's about $205,000. So that means that about 40% of your overall earnings get taken as tax, hence that tiered system. Now, when we talk about taxable income, we're not just talking about the money that your employer pays you, for example. We talk about all sources of income here. So we're talking not only employment income, but also if there's been any dividends or distributions, any rental income on your investment properties. If you've made profits from investments when you've bought them and then sold them again, that is likely to get added too. All of that gets bundled together to give you a single taxable income figure. And then whatever that taxable income figure is, that then defines what amount of tax you're going to pay using this formula. It's quite straightforward. Now, there are two key things to consider here that have a big impact. In addition to, of course, your tax, whatever income you earn throughout the year. The first is what we call the tax deduction. Now, tax deduction often comes about because you've incurred a cost that was associated with earning money. And what happens there is that'll actually wash straight off your taxable income. So let's imagine for simplicity you'd earned $100,000 for the year and you had tax deductions of $10,000. Well, if you were running these calculators and determine what my tax payable is for $100,000, that's going to give you $26,000 or thereabouts. But if you commensurately had a $10,000 deduction, you'd only pay tax on $90,000 instead of $100,000, which would reduce that by around, not quite, but around about $3,450 of tax saving. So tax deductions are good. The other feature here is what we call a tax offset, and a tax offset trumps a tax deduction. A tax offset doesn't kick in at this point when you're calculating the amount of tax that's payable through this table. We talked before about the $100,000 income and then earning tax and then paying tax, let's say $26,000. If you had a $10,000 tax offset, that eats up the actual $26,000 that's remaining, the tax bill. So a tax offset is always better than a deduction. They're naturally quite a bit harder to get, mind you. But in that scenario, if you had a $100,000 income or taxable income and a $10,000 tax offset, the total tax that you pay would only be $16,000, being $26,000 minus the $10,000 offset. This is naturally an area where you'll get a lot of support from a lot of professionals, financial advisors and accountants alike. But certainly when it comes to your investments, it's incredibly important to understand how tax works and be able to do everything that we can to keep your taxes as low as possible, because the lower these are, the more of it is kept in your own pocket. Thanks everyone. Have a great day.